Welcome to this Killick Explains video and welcome to part one of a two-part series called How to Compare Shares and Bonds. This being part one, part two to follow. Why do this topic now? Well, with inflation on the rise, interest in bonds has increased as people look for safe havens for their capital, look to spread risk and so on. Bonds have always been reasonably popular amongst seasoned investors, but there is a renewed interest now that yields have started rising. So this video and the one that follows is a kind of jargon tour to just bring up the comfort factor, because I find that people generally think they understand shares and are less comfortable with bonds. So where do we begin? Both are good long-term investments. So what are the key differences? Well, here I'm going to take on just three in this particular video. One, the idea that you can have permanent versus temporary capital, or sources of capital, if you like, if you're looking at it from the perspective of a company issuing these things. Dividends versus coupons, that's an important distinction for investors. And there are one or two legal differences which, without going into the depths of the detail, are quite important. So let's go back to these in turn. Capital types first of all. Shares are often described as permanent capital. And what that means is when you buy a share in a company, typically it's not redeemable. It doesn't have a fixed date at which the company promises to buy it back, like a loan for argument's sake. It is therefore known as permanent capital. Now, there is a way that companies can buy back shares. I'm not too keen on it. I've done videos in more detail on this. It's called a share buyback. So there is a mechanism by which a company can go to shareholders and by agreement buy back shares, take them out of the market in proportion to the existing holdings. It's not a random exercise, if you like, but there is no mechanism by which normally as a shareholder you can kind of insist on your money back. The way you would offload a share is not to the original issuer, but is in the open market via the London Stock Exchange, via an advisor and so on. Now bonds, on the other hand, IOUs as I call them, issued by governments or companies, are usually fixed term. Now there are complications, there are twists. Some bonds come with more than one date, but there is normally a fixed redemption or maturity date as it's known. So unlike shares, bonds are not typically what's called permanent capital. They have an expiry date, if you like. So in effect, as an investor, you are lending money to the company in the expectation that eventually it'll be repaid. Now you can trade a bond on in the meantime, but there is nonetheless that fixed redemption date. So people who hold bonds all the way through to redemption know when they'll get their money back and they know the amount, subject to no default in the meantime. So they're usually redeemable, as it's called, and the company must, under its loan and debt obligations, pay to redeem those bonds, these IOUs, on maturity. Okay, so there's point one. Point two, I mentioned earlier, was about income streams. And this is important. As an investor, you might be looking at shares and or bonds as a source of income. That's not uncommon. It's possible you might be looking at shares in particular as a source of growth instead. If you're looking at them side by side for income, well, shares on the one hand pay variable dividends. Now, it may seem like they don't sometimes. Companies like to try and keep up their dividend payments so they don't disappoint investors, but nonetheless, if things go wrong, companies can vary the level of dividend paid and even cut it altogether. Now, as a sideline, there is a class of share called a preference share, which normally carries a steady dividend, but ordinary shares, which are what most people end up buying at the London Stock Exchange, have a dividend variable payment. Okay. Now, when you look at bonds, you're talking about coupons, and coupons or interest payments are typically fixed. So there's a fixed amount paid, for example, every 6 months, depending on the interest rate quoted on the bond. So if it's a 3% bond, for example, with a nominal value, a fixed nominal value of £100, you can expect to get £3 in 2 instalments, if you like. Now, Occasionally, you will see those coupon instalments deferred by agreement with the company's creditors, but it's highly unusual. In other words, when companies issue bonds, they do fundamentally, or the government, commit to paying regular coupons. And that's a differentiator between bonds and shares. And then the third point I mentioned earlier is the legal stuff, if you like. And before your eyes glaze over, this is quite important. So 2 or 3 points to make here. One of them is that were a company to get into trouble, were it to actually go bust, bondholders, debt holders have an earlier right to get their capital repaid than shareholders. Often, there's very little left for shareholders once a company is liquidated. Now, you might say that's unlikely, but actually in the current climate, more companies are coming under pressure. More companies, especially at the sort of smaller range, will run into trouble. Secondly, let's assume the company is not in trouble. Coupons on bonds, interest payments have to be paid before dividends by law, so that strictly the pecking order is interest on any debt or bonds, then preference dividends, I mentioned those briefly earlier, then ordinary dividends. So that gives bondholders, again, a little advantage. All right, and in general, that's a rule of thumb that any company of any size that takes out loan capital should expect to repay it ahead of any amounts going back to equity shareholders. Now there's a flip side, I'm going to finish this, there's a flip side of that coin, which is as a bondholder, you don't have voting rights, you don't have ownership over the company in the same way that shareholders do, and that's an important perk for some people when they buy shares. But nonetheless, hopefully you can see that overall there are 3 quite important differences between shares and bonds: the nature of capital provided, dividends versus coupons, and the legal stuff. And in part 2, I'll take on some other key features. Now, to find out more, it's a big topic. I'm comparing 2 big asset classes here. You can go to several places. One is my how-to guide. So if you want to know more about equities, for example, there's one sitting next to me here. That would be editor@killick.com. If you wanted a copy of Confidant, our quarterly magazine, where the equity research team often give a view about an aspect of the market, that would be editor@killick.com. And we have a comprehensive video library, and there is a bonds tab within it, and that's killick.com/learn.